I haven't got the answers necessarily of how do we reduce this domestic inflationary pressure we have in New Zealand. But part of it comes back to regulation and legislation that government just passes it and it just adds cost and never adds prices for the average household. And no one ever sort of, questions it. 30 years ago, Ruth Richardson was the finance minister and she introduced the Fiscal Responsibility Bill, put accountability on deficits and reporting and, 4 times a year and all that. So you couldn't just pass legislation and do things as a government without regard to what you're doing to the government deficit. Maybe we need the same for inflation. Every piece of legislation or regulation that's passed, and it's got to have an inflation filter put over it before it's passed into law because, there's no accountability for it. And there seems to be, and clearly monetary policy, interest rates can't control it.
Hey, welcome everybody to the latest Everyday Investor podcast. If you're new here, I cover things like crypto, managed funds, property, both commercial and residential, and the strategy, both macro and micro, to bring it all together. If you haven't already done so, make sure that you check out the link in the description to sign up to my free fortnightly newsletter. But today we're catching up with currency expert Roger Kerr. The US dollar, the end of the so-called petrodollar agreement. What's up with the BRICS nations' currency? Is that a threat? Yen carry trade, all that sort of fun stuff. If you're an investor and you have money in offshore markets outside of the country that you're living in, you really need to understand how currency movements work. So buckle up. Hope you enjoy this episode. Subscribe. Let's get started.
Can you just cover off not exactly, but more or less what you do?
So, we're financial advisors, but I guess the niche is in foreign exchange and interest rates. I tend to specialize more in foreign exchange these days. Over the years, everything to do with corporate treasury management. So, we advise New Zealand companies that are not big enough or they don't justify a full-time treasurer to manage, the debt, the interest rate risk, the currency risk, commodity price risk. So they use independent advisors to assist them with what's going on, hedging programs, hedging strategies. And so it's a specialist advisory role. And I've been doing that for quite a long time now, but still love it. Yep, still in the business. Yeah,
of course. And so you've been doing this for quite some time. Your eyes are on the currency market all the time. And I guess everything that's directly or indirectly connected to what influences the value of $1 more than the other. You kind of have to keep abreast of quite a few things, I would imagine. It's not like a very singular area that you're watching. You have to be quite macro aware.
Absolutely. So we're monitoring, economic events and numerous economies, and particularly the US and New Zealand and Australia, because Kiwi dollar does tend to follow the Aussie dollar. So I spend as much time analysing and getting insights to what's happening in Australia as I do in New Zealand. But, pretty much the last few years, it's the US, because if you look at the New Zealand-US exchange rate and what's driving it, the movement, the direction is entirely the US dollar side. That hasn't always been the case, but in recent years, that certainly is the case. So, what the Fed's doing, what's happening with inflation and employment and all the other economic indicators in the US is what we keep a monitor on. And then, of course, there's the unknown unknowns. It's we can talk about it, but, geopolitical events, wars, change, government changes. You don't know, there's a risk those things can happen, but you can't predict or forecast them, of course. And that's why companies have, the companies that we advise, they have minimum hedging levels, because you might say, well, why hedge if the currency is going to go your way? But something comes along in the world that you don't know about, and you can't be exposed to that 100%. So that's just basic risk management, really, financial risk management.
There was actually one of the things I was going to ask you is that it feels like the New Zealand dollar is somehow related to the performance of the share market in the US specifically, right? Because if there's a real scary catastrophic event over there, the value seems to go up in the US dollar because it's a flight to safety, so the demand goes up. If that's happening, then the New Zealand dollar is going down. That's technically a risk asset. So you're kind of pushing from the shocks and the blows, but I guess volatility in any direction is a little bit scary when you're managing a large business, right?
Yeah. I mean, the whole purpose from a corporate company, importer, exporter point of view, or overseas investor, managing risk is about reducing volatility, and therefore, it's corralling the potential, return outcomes or profit outcomes into a band that's acceptable by hedging. It's not trying to beat the market. It's not trying to forecast the market. It is putting in place protection, risk management strategies that give you outcomes within defined ranges. And we help companies work out what they are in advance and put in place hedging programs and instruments to achieve that. So that's financial risk management. It's just in a very specialist niche area.
Okay, so today I wanted to ask you a few questions. Mainly, I guess all of it really relates to the US and the US dollar specifically. So there's a couple of definitions we should probably get out of the way, or at least one anyway. And well, not one, but this is the one that I'm thinking about. DXY. So the DXY. Can you just explain to us what the DXY means? What it's referring to?
That's an index, and there's a futures market on it in the US, but it's the overall value of the US dollar, and it's the value of the US dollar composite of 6 currencies. Now, in New Zealand, we have a trade-weighted index, so that's an overall value of the New Zealand dollar against all the currencies that we trade with, and that's about 20 currencies in that basket or in that index. In the US, that's just historical. The DXY is just 6 currencies, so the one that dominates it is the Euro-US rate, so that's 58% of that index. So it is, it's the biggest traded currency in the world is the Euro-US exchange rate. And then the Japanese yen, the pound sterling, Canadian dollar, Swiss franc, and for some reason, I don't know, never understood why, the Swedish krona is the 6th currency in that index. Don't know what's special about the Swedish krona, but it's not the euro. So, when I talk about the value of the US dollar, overall value of the US dollar, it is the DXY.
Yeah, and this is the weird thing about currencies, thinking about currencies as a thing. The value of that thing is really, I guess it's an expression of, or it's a function of, derivative of the value of other things relative to it, right? So like you're saying, that the DXY is composite index, so it's deriving its value from the equal and opposite forces on the other side, right?
So it's the US euro movements, the yen US movements, the pound, the cable pound US movements in Canada. So that's composite movement. Any exchange rate as a price, it's a relative price, isn't it? Because it's one economy relative to another. That's how you can think about it. And so if one economy is performing well, got strong growth, low inflation, and another economy's got high inflation and low growth, you might say that's New Zealand's situation today. You'd expect, one currency to be strong against the other. Now, that's theory, in perfect world, doesn't always hold. So a lot of other things come into it. That's why I find it so fascinating, really. It's relative pricing, and it's one economy against others, and all these other things that could come in and affect it as well.
It almost is representative of shares, I guess, in that country as well, in a way, right? Because they're issuing new shares all the time. Some of those shares are being bought back. I guess that's analogous to the monetary policy, but is that kind of one of the ways that you can look at it? Is that the dollars are kind of like shares?
Well, what drives changes in exchange rates at the end of the day, in my view, it's capital flows. So if investors are taking their capital out of the US and putting it in Australia or New Zealand in sufficient large amounts, and they're buying New Zealand dollars and Aussie dollars to do that because they don't like the US economy, but they like Australia and New Zealand and Aussie dollars will go up. There's more demand than there is supply, basically. So, long-term capital flows do have, in the end, have a big influence on exchange rate values. But in the shorter term, obviously, there's a lot of speculation. There's portfolio managers that are shifting money around the world and increasing their weightings to the US dollar or reducing their weightings, and that, across the asset classes, so equities, property, bonds, commodities, So, when talking about, outlook for a currency, you really do have to define the time horizon. Short term to me is, the next few weeks. Medium term is probably, now it depends, people have different definitions. My definitions, medium term is like 2 to 12 months, and long term is greater than 12 months. Now, if anyone can forecast a currency or predict a currency greater than 12 months, I've never seen anyone really do that. So it is highly unpredictable, but all you can really do is, in terms of forming a view, and we hold pretty firm views and we don't change them too lightly either. You just got to take all your insights, all your interpretation of what's going on, put it together and say, well, what's going to influence? What's going to change? What have the FX markets today already priced in? So they've already built that into the price, so the Kiwi-US exchange rate. What haven't they built in? What could change in the future? And therefore that helps you form a view of, where the exchange rate could be, moving sideways, moving up, or moving down. There's no, scientific formula or anything like that. There's a lot of things happening in the world, of course. There is a lot of, in the short term, there's a lot of speculative positioning and futures are used and how the market position, hedge funds play in the currency markets a lot. In the past, we've seen in New Zealand, investors out of Asia, we've seen, the Belgian dentists and all the rest of it, buying New Zealand dollars because we had higher yields than other currencies. That's not the case today, but that has been in the past. So, many variables, and sometimes they dominate. One could dominate, and other times they don't, and the correlations and the relationships break down. So, it's always a ever-changing environment, put it that way.
It's very difficult, right? Because there's multiple factors moving all over the show, and they're always changing and emphasizing. So maybe if we can kind of focus on one, just go a bit further here and talk about the US dollar, the USD. And you wrote something on LinkedIn, which is effectively what caught my attention not long ago, around 4 main considerations for US dollar strength. Do you want to take me through those 4 main considerations?
No, absolutely. And there's no rationale why it's 4 and not 10, but I just focused on 4, let's call them buckets of influence on the US dollar. And the first one is geopolitical events and geopolitical risks. So that's things happening in the world. And if it's like when the Ukraine war broke out, or Israel and Hamas, generally the US dollar strengthens when there's increased tension in the world. There's a risk of, wars upsetting trade routes or investment or whatever it might be. As you said earlier, safe haven. People go back to the, so-called reserve currency of the world, which is the US dollar. So US dollar tends to strengthen when there's those geopolitical events. And if I look forward now, I think the influence of the Ukraine war and the Israel-Palestine situation is probably less intense today than what it was a few months ago. They're probably the US dollar wouldn't say is strengthening because of those things right now. But if I look forward and, the whole spectre of trade wars, we're seeing, in Europe and China putting tariffs on each other. If Trump is elected in the US, he's going to put massive tariffs on Chinese imports into the US. And just trade wars is, from a New Zealand perspective, not good news for a trading nation like us. And generally, we've seen in the past when there's trade wars, a lot of tension, threats of, countermeasures and reciprocal and all that, the US dollar does tend to strengthen. So they're the sort of, you don't know in advance when those things are going to happen, but when they do happen and the risk goes up, generally it's positive for the US dollar. So that's geopolitical risk and events, and you can't predict those. Secondly, I think is relative economic performance. So that's just looking at, is an economy expanding or contracting, GDP growth? Is an economy competitive globally? And if one economy, say US compared to New Zealand right at the moment, you'd say, well, the US is growing at 1.5%, 2% per annum. They've got inflation down to 3%, heading to 2%. Whereas New Zealand, we've got zero growth, where the GDP figures today. Let's say we're at zero growth. It's not a deep recession, it's a mild recession in New Zealand, but pretty shallow. But we've still got inflation, domestic inflation is 5.5%. Overall inflation, 4%. So you compare those two economies, you say, well, the US looks a lot stronger than New Zealand, therefore the New Zealand dollar should be going down against the US. In the last, 6 months, has the Kiwi dollar gone down against the US? Well, not really. It's gone sideways. We've been between sort of 59 and 62, 63 for quite some months now. So, but generally, overall, you say if one economy is more competitive than another and is growing and it's attracting foreign investment into it because of, good economic conditions, growth prospects, rising share market, or, money will go into that, global funds will go into that economy, and you'd expect their currency to strengthen, appreciate. So that's just relative, economic performance. Another example is between Australia and New Zealand at the moment. The Aussie economy is probably growing at 1.5% at the moment, New Zealand 0. You'd expect the Aussie dollar to be strengthening against the Kiwi and that cross rate to be going down. It's not the only thing, because I guess the third of my my buckets or my forces on the US dollar is interest rate differentials. And, in recent years, particularly since COVID, and there's this massive cutting of interest rates to zero, money printing, and, the reverse since, with, interest rates hiked up to control the inevitable inflation. The difference in interest rates has a big bearing on a currency. So you probably, and listeners may have heard of the carry trade. So, investors around the world will go into one currency because it's giving a high yield. And we'll take the example of the difference between Japan and the US. So, short-term interest rates in the US are 5.5%. Short-term interest rates are in Japan are 0%. So clearly what speculators and investors do, they borrow Japanese yen at 0%. They then sell those Japanese yen for US dollars and invest the US dollars at 5.5%. And that's what the difference, the interest rate difference is called the carry trade. They earn 5.5%. If the currency doesn't move, they're 5.5% better off. But if the yen weakens and the US dollar strengthens, they make even more money. So that's our interest rate differentials. And that's why, like, you take New Zealand today, we've got 5.5% interest rates, same as the US. That's been the case for 12 months now. And that's why, even though the Reserve Bank here in New Zealand has tightened monetary policy to push interest rates up, and normally in the past when they've done that, the New Zealand dollar goes up, and that helps lower inflation because imports become cheaper. And in the last 12 months, that just hasn't worked because the US has the same interest rate as us. Therefore, even though they've tightened policy in New Zealand, imported inflation hasn't really gone down too much because the exchange rate we're still in the low 60s, right? So that hasn't worked. But in the past, when New Zealand interest rates have been 1.5% to 3.5% above those in the US, we've had the carry trades come in, money comes into the New Zealand dollar and pushes it up. So interest rate differentials, and it's not like the difference between the interest rates today, and often what drives the flows and the speculative flows is what will the interest rate differential be in 6 and 12 months' time. And then people take positions based on that. So the Aussie dollar, for instance, the Aussie US rate, the Aussie has been very weak against the US over the last 2 years because Australia's interest rates, they tightened monetary policy, but not far enough in my view. So they only put their interest rates up to 4.3%. The US had 5.5% for the last 18 months. So, the Aussie dollar, if you're owning Aussie dollars, you're 1%, out of it. So that's why the Aussie dollar's been so weak. Now I'd say that's now changing. If I look ahead now, I'd say the Aussies probably have to raise their rates again. Now, people are speculating whether they will or not, but they're certainly not going to cut them for a while. And they may have to raise them again, and the US is about to cut. Over the next 6 months, the US will be cutting 1 or 2, 3 times, I don't know. But they'll be cutting rates. So that whole differential, which has been so negative for the Aussie dollar in the last 2 years, is about to change, looking forward. So that's interest rate differentials, the third one. And the fourth one is, in the past, it is commodity prices and energy prices. So that's oil. For New Zealand, that's obviously dairy prices, our biggest export commodity. In Australia, it's the iron ore and uranium and the metal and mining prices. And in the past, the Aussie and the Kiwi dollars have been viewed as commodity currencies. So if those commodity prices are going up, it's good news for both economies, for the export sector, and the currencies tend to go up because the economies do well, right? But that's broken down, in recent years since, New Zealand's interest rates have been the same as the US, and Aussie interest rates have been less than the US. That whole relationship of commodity prices driving our currency values the relationship has been disrupted. It doesn't hold anymore. Now I think it'll come back because at the end of the day, our economies are based on export commodities. But one thing I've observed with the US dollar, people used to say the US dollar moves inverse to oil prices. And the reason for that was when, oil prices went up, and oil prices are priced and traded in US dollars. Oil prices went up, economies like Europe and Japan, that they needed a stronger currency to counteract that so that their imported cost of oil in their local currency was stable. And that was always been the way many years. But actually in the last few years, oil prices in the US dollar move the same way. They're not inversely correlated at all. And the reason for that is, oil does have a big impact on inflation in the US and every country. And if oil prices are going down, that reduces US inflation. That helps the Fed to cut interest rates, and that's probably negative for the US dollar. So recently, I've been observing, and you look at the chart, and you say, well, what's driving what? And if oil prices go up, the US dollar tends to strengthen. Oil prices go down, US dollar tends to weaken. So, and there's a lot of things affect oil prices. And as you can imagine, the Middle East, supply, demand, you go through what, and I don't pretend to understand everything that drives oil prices, but it does influence currency values. So they are the sort of the four biggies, as it were, in terms of the US dollar. And right now, I'd say, on relative economic performance, that has been positive for the US dollar in the last 2 years. I mean, the US economy's done better than others, so the US dollar would be stronger. On interest rates, they've had higher interest rates than other, Australia and Japan and Europe and China. So that's positive for the US dollar. But looking ahead, I think the US economy is slowing, and recent data has been a bit more sluggish. And whereas I think Europe and UK, for instance, are probably recovering now. So that economic or relative economic performance is probably changing a little bit now, not so positive for the US as it has been. And you look at interest rates, well, that's the big one. And, if the Fed do cut, and over the next, 6 to 12 to 18 months, they cut a long way. And because US inflation is 2%, they've achieved their target. Other currencies or economies like New Zealand and Australia don't cut interest rates until well into next year. You'd expect the US dollar to weaken against those currencies. So might be right or might be wrong on those timing. And I always thought the Europeans would be cutting interest rates 6 months after the US, and 2 weeks ago they cut, and the US haven't cut yet. But the euro actually didn't weaken on that. It has actually weakened just in the last week. The euro has weakened a little bit on what's happened in France. With Macron calling an early election, that's upset investors into France, and that's been viewed as negative for the euro for the short term anyway.
So I want to pull on just one of those pieces for now anyway, the geopolitics bucket. So thinking about the US dollar and just how big of a factor geopolitics are. There's kind of two branches that I'm kind of thinking about, and this is mainly because one of my interests is in gold. And so when you're interested in gold, you listen to all sorts of stuff, and a lot of it it's kind of twisted to build a narrative that ultimately means that, hey, we're going back to a gold standard, therefore you got to ape into gold now because, hey, everything's collapsing and we're losing faith in the world's reserve currency. So I want to kind of just put a bit of pressure on some of those theories to put them into the correct place. So with, say, for example, the petrodollar agreement, which is, from what I understand, a very loose sort of agreement that happened around 1974-ish. There was the media report that came out recently saying that, hey, it's come to an end, it hasn't been reviewed, and now there's not going to be any demand for US dollars. And then very shortly afterwards, you see some other people coming up saying, no, that's not true. There never really was an agreement. If there was, it was in August, not in June. So there's all sorts of stuff going on in terms of explaining how the world works. But can you just define, if there is such a thing as the petrodollar, what is the petrodollar?
Yeah. Well, it used to be, that's from the 70s and 80s, really, and it was about the Arab oil producers obviously selling the oil in US dollars, then using those profits and those receipts to invest in US dollars into, say, US Treasury bonds, help the US fund their deficits, right? So that was the recycling of the petrodollars, and that's what that was called, the petrodollar. But things have changed dramatically. These days, the US dollar is not reliant on the Middle East for its oil and its energy. In fact, the US is a net exporter of oil these days. So that's just, that's why we've seen this, blow up with, Israel and Palestine. Has the US dollar really strengthened on that? I mean, in the old days, it would have huge, because it would have been a flight to safety, problems in the Middle East, disruption to supply, oil price, all that. But the US is not dependent on the Arabian oil producers anymore. So that's changed dramatically. I mean, you look at who are the big investors and holders in US Treasury bonds, it's China, Japan, Europeans, and the Norwegians, they're huge, as well as, Kuwait and Saudi and all the rest of them. But it's much more dispersed compared to what it used to be.
It's something that's probably been evolving over time, and there's still plenty of demand for US dollars, hence why the Dixie is where it's currently at, right?
Yeah, and a lot of the currencies are like you take in Africa or the South America, the Middle East. Their own currencies are not internationally traded. Therefore, everything's really priced, valued in US dollars. Now, New Zealand, we've had a floating currency since 1985. What used to be about the seventh largest traded currency in the world. It's now about number 14. I think we're number 14 now. But there's a lot of, in the past, there's been a lot of interest in the New Zealand dollar, free floating, no intervention. But in terms of the size of our economy, we're like number 62, I think, in the world. So it's out of proportion. But a lot of in Asia and in Africa and South America, they're not free floating currencies, controlled to certain degrees. And even the yuan, they've been trying to internationalize that, the Chinese yuan, but that's not there yet. And you're still not free floating. I think it's been, you might say it's been a bit of a roller coaster for the New Zealand dollar for 40 odd years. But it is the best, floating currency where it's just, supply and demand every day determines the value, has been the best for New Zealand because if our export commodity prices plummet, the Kiwi dollar will go down, and that's an automatic buffer, an automatic shock absorber for our economy. So it's pretty important for us that we do have a floating currency. And overall, I think it's worked very well, though. Lots of people will say, we're just a speculative, toy with hedge funds sitting in New York. Well, that may be the case, but they give liquidity to the market, and they're very short term. So, I think, if the argument is, should we have a floating currency or a controlled currency or managed currency, the answer clearly is, a free float is the best for New Zealand.
So thinking then, again, with the US dollar, and another story that I read just recently was around, you mentioned the Japanese carry trade, right? Where they're borrowing for next to nothing, moving into US dollars, and they're basically putting it into the equivalent of a risk-free trade, which would be treasuries, presumably.
Yes.
What was starting to happen now is because of the negative yield curve, where the rates on longer-term money is cheaper than the rates on short-term money, it's actually not very profitable. And so what's happening is a lot of these financial institutions in Japan seem to be making losses, banks making losses there, but it's just because they're realizing that sale because they want to get that money out of that trade and put it more towards higher risk plays because of this, the direction of that curve. I don't know if I've explained that very well. So if you understand what I'm saying, if you could kind of reflect that back with more accuracy.
For as far as currency markets are concerned, the Bank of Japan has intervened recently. They spent $60 billion trying to defend the yen from weakening any further. And of course, the reason that the yen has been weakening is the carry trades, right? People have been selling yen and buying other currencies. And they, for 30 years, they've run at 0% or negative interest rates. And now they've realized they have to change. And they seem very, very slow and overly cautious about making that change. But they do have inflation and higher wages in Japan. So they do have to go back to positive normal interest rates, which is 1%, 2%, 3%. And they haven't had those for many years. And they seem to be rather scared of doing that. Does intervention work in terms of preventing the yen from weakening? Well, it probably has stopped a lot of the speculation against the yen because it's sort of got between 155 and 160 and it's sort of stopped there. It hasn't turned the yen around and strengthened it. It's never designed to do that, of course, and there's a lot bigger forces at play. But what the big Japanese investment houses do is pretty important because the yen is in my experience over the years, it's a tricky currency. It goes nowhere for months and months and months, and then it moves, 15% in 3 days, as they all follow each other. It's a weird one. And from a New Zealand perspective, that New Zealand yen cross rate, 2 years ago it was 70. Today it's 96. So even though you might say, well, the New Zealand dollar hasn't done really well against the US, it's been stable at the low end at 62 cents, 61 cents against the US. It's made major gains against the Japanese yen, which makes it very difficult if you're exporting, squash out of New Zealand into Japan. You're not getting very good prices because the yen has weakened so much. So, I don't particularly have a view on, yield curves in Japan, but, clearly what they should be doing is lifting their interest rates, and they've been very slow to do that.
Because of some of those dynamics at play, will that lead to less demand for US dollars because it's just not as profitable for that trade to occur? Therefore,
It needs the Japanese to lift their interest rates before that will happen. And so far, they really haven't done that. So so it's going to have to move, like instead of being 0.2% interest rates, it's going to be, something has to be much higher than that.
Okay. So that's one thing. And now another thing in the geopolitics area would be the BRICS nations. So another block, another currency block, potentially trade partners evolving. Maybe eventually they form a government. Who knows where it eventually goes? But is it worrying, or is it not worrying, the pace at which there are developed alternatives to using the US dollar system? Do you think it will ever result in lower demand for the US dollar and therefore falling US dollar? Or is that something that would play out over way too long of a time frame to be able to model?
Yeah, look, I don't see other currencies, even combined currencies like a BRIC currency. I don't see that ever happening and replacing the US dollar. Now, the US dollar will always be the reserve currency of the world. And what do we mean by a reserve currency? Well, what it means is like countries like, Japan, China, Asian countries, where do they hold their excess reserves or their excess funds? Do they hold them in all of their home currency, or do they, they spread their risk around the world and they hold them in US dollars? That's what's meant by they invest their reserves in US dollars and other currencies, but mainly in the past it's been in US dollars because that's seen as safe and secure, and it's got a high credit rating and all the rest, all the other reasons. Now, you might look at it and say, well, the US government debt's huge, their debt servicing costs are through the roof, they're running deficits, that can't sustain. Both Biden and Trump are going to make it worse. I mean, why would you hold it in US dollars? And US interest rates have been high, so that's a good reason for holding it in US dollars. But if US interest rates were to return from 5% down to 3%, it might be, people will be diversifying a bit out of the US dollar and looking for alternative currencies to invest their reserves in. You might say the Chinese, for instance, you mentioned gold earlier, they've been investing in gold heavily the last 2 years as a diversification away from US dollar treasury bonds as their investment of their reserves. Other current countries have gone more into the higher weighting towards the euro and less to the US dollar, but it's all, to be honest, it's on the margin. Would the BRIC currencies form their own composite currency as a competitor to the US? Don't see that. Brazil, Russia, India, China, don't see it. I mean, the Chinese have been trying to internationalize the yuan, but until it's free floating, that's not going to work. People are still going to prefer to do investment and trade in the US dollar.
Yeah, and I guess what you're saying, though, is at the very least they are, and you mentioned China buying more gold, potentially that's more of a story of them trying to diversify into other assets rather than just talking about gold, right? But let's get out of the US maybe a little bit more. But is that kind of a trend? Is that there's a lot more diversification at play, rebalancing of portfolios?
Oh yes, that does happen, but it's not like the 70% US dollars, 30% euro, and then they change that overnight to 20% US dollars. They just don't do that. That's on the edge, We've seen the Reserve Bank of New Zealand recently increased their US dollar reserves. That was last year, sometime last July, I think it was. And they actually bought US dollars on the FX market to do that. So they bought US dollars from New Zealand to increase the US dollar reserves. I mean, when they need a higher Kiwi dollar to bring down inflation, and they did send the Kiwi dollar lower. So that was a bit surprising that they did that. But I would spread it over 9 months and do bits every day. But they appeared to do, a few billion in the space of 2 weeks. So that's surprising that they don't understand, managing of FX risk. Look, governments, central banks, sovereign wealth funds, they obviously have diversify their currency risk with their investments, and they do make adjustments in terms of the weighting of the currencies in their investments.
So with the interest rate differential, so this you mentioned was another one. So really simplistically put, 5 different parties, and whoever is offering the highest interest rate, you're going to attract all the money, right? So I'm by just thinking of it really simplistically like that. But if we think about the reserve banks in, say, the United States, Canada, UK, Australia, New Zealand, I guess as soon as one drops, then it's changing these dynamics in terms of the values of each of these currencies. And so how important is it that the interest rate drops will be minor from here? Like if everything is going according to plan, and is it best for all the central banks to reduce the interest rates at the same time? Or is it possible to actually do that? Does it have to be kind of limited by what's happening in that country?
Yeah, I'd add both of those things, really. I mean, look at the Reserve Bank of New Zealand here now. If they cut interest rates now, before the US cut interest rates, that clearly would weaken the Kiwi dollar, and that would push inflation up. Now, they're trying to get inflation down. So that'd be a pretty dumb thing to do. So for a small economy like New Zealand that is highly exposed, import penetration is huge. So the currency value plays a big role in the level of inflation in New Zealand. So, probably the Reserve Bank of New Zealand, they do look at, how if we're cutting interest rates, are we cutting at the same time before or after the US? I think they do look at that. But the US does not look at other current, like the Fed. They couldn't care about the exchange rate, to be honest. It's more to do with the Treasury in the US. So, and import-export is only 10% of the US economy. So it's less important. So the Fed does not think about exchange rates when it's raising and lowering interest rates. But a small economy like New Zealand, they do. And they do think about, what's happening in the US and interest rate differentials, is that affecting the New Zealand dollar?
So would that then create a problem every time then? Because obviously this was set in motion in March 2020, right? So everybody had to reset their clocks according to that then. And the inflation story doesn't play out in the exact same way in each country. So does it not create this embedded risk that every time it's a requirement to drop interest rates, New Zealand will always have to lag behind the US?
Well, not always. It depends what our inflation rate is and what the US inflation rate is. The US inflation, they tightened the monetary policy a couple of years ago to bring their inflation down from 9% down to target, which is 2%. And today they're at 3%, so they're not very far away from it. In the next few months, they'll be getting close to 2%. So they've done a good job, right? Fed have done a pretty good job. They've got inflation down without causing a recession, without causing unemployment to rise in the US. So that's pretty spectacular. And they get criticised a lot, but overall that's a good result. Take the Reserve Bank of New Zealand were first to tighten, push interest rates up, 18 months ago, 2 years ago. But here our inflation rate is still 4%. Our domestic inflation rate's 5.5%. So, clearly we have a problem because there's lots of price-setting behaviour in the New Zealand economy that's just not sensitive to interest rate movements. So our interest rate's 5.5%. So, no one really talks about that, and no one seems to have the answer to address that problem, but we have a problem. It's called domestic non-tradable inflation. It's always been 4% per annum for 15 years, every year. And, and it's a function of, public sector. It's always putting their prices up. There's no discipline of competition or price-setting behaviour. You might say, economies of scale, small economy, many industries are not competitive. Therefore, we have a high domestic inflation that you could say was disguised for many years, because from 2012 until 2020, we were importing deflation from China. Everyone was, as prices were going down, right? And that disguised some of the underlying problem of that domestic 4% inflation every year. And it was really good to see the Reserve Bank's last statement. They finally and belatedly recognised we do have a problem with non-tradable inflation. Rates, rents, insurance, building costs, healthcare, education, and we do, and that's why we're always going to be a little bit different to the US. The US do not have those sticky domestic inflation, and things are much more move very much quickly. Although, having said all that, how they measure some of the inflation in the US is archaic, and how they measure housing costs, rents. They call it shelter. It's like out of the dark ages, but hey, we won't go there.
I like it though. So in New Zealand, what you raised though is really interesting. That for the last 15 years, it's been possible to effectively siphon off the benefit that we were receiving from low imported goods or deflation. Just kind of being traded off against being inefficient, really, spending money without getting much of a result for it. And that's going to be really hard to wean us off of that, I would imagine. But that's ultimately what kind of needs to happen, right?
Yeah, that's right. And, and I haven't got the answers necessarily of how do we how do we reduce this domestic inflationary pressure we have in New Zealand? And part of it comes back to regulation and legislation that, government just passes it and it just adds cost and therefore adds prices for the average household. And no one ever sort of, questions it. And, years ago in New Zealand, or 30 years ago, Ruth Richardson was the finance minister and she introduced the Fiscal Responsibility Bill, which put accountability on deficits and reporting and, 4 times a year and all that. So you couldn't just pass legislation and do things as a government without regard to what you're doing to the government deficit. Maybe we need the same for inflation. We need every piece of legislation or regulation that's passed, and it's got to have an inflation filter put over it before it's passed into law, because that's our problem in New Zealand, and that there's no accountability for it, and there seems to be clearly monetary policy, interest rates can't control it because it's insensitive to that. Yet the Reserve Bank are charged with keeping inflation between 1% and 3%. But you've got this whole domestic price pressures that's always been there, that they have absolutely no influence over. It's a problem. We want to be competitive in the world. We've got to solve that problem. And it's brave politicians to do it. Yeah.
Yeah. And I guess not just politicians, but it's, I guess, a lot of money, a lot of households derive their income indirectly or directly from government spending. Yep. And so it's just asking for a different part of the population to wear the pain. And I guess that's pretty hard, right? And no one wants to be the one that's carrying a disproportionate level of cost, right?
Yeah, I think in New Zealand in the past, because the Reserve Bank, they tighten monetary policy when inflation goes up, and the sectors that bear the pain of that is normally the productive sector. Exactly. So that large industries that are borrowing or exposed to the Kiwi dollar. And, they bear the pain and the economy slows and eventually inflation comes down. But is it fair and equitable? And the answer is, probably not. But that's where we are.
Yeah, those are some great conversations that somebody needs to have. Luckily not you and I. Just generally, we are recording right now. By the time this gets out in July. So thinking about the next, say, 4 months between now and November-ish, what do you think is going to happen? Obviously, we have a U.S. election at play. We've got these geopolitical hotspots, which seem to be on a knife edge. And there's always something going on. We don't really know if it's going to be alien disclosure or earthquakes or whatever, right? But what do you think is going to happen in terms of currencies and as it relates to interest rates, especially?
Well, we do see the Fed cutting rates, and whether they cut 1, 2, or 3 times this year. I mean, if the data's weaker over coming months, they'll be cutting 3 times. So that does, long-term interest rates will go down in the US, the bond yields, and that, the US dollar index tends to follow that. So I'd say a weaker US dollar. I've been saying that for some time, and it hasn't really strengthened over the last 18 months, but it has weakened either. But it's certainly if the US start cutting rates, because they've hit their 2% inflation target, that would tend to weaken the US dollar. And even though the New Zealand economy is not doing very well, we could see the Kiwi US rate at 64, 65, just on the back of a weaker US dollar. And then you've got the Australian situation. So the Kiwi dollar follows the Aussie US, and if the Aussies did raise interest rates, that would certainly, they'd be raising interest rates when everyone else in the world is cutting interest rates. So that would certainly propel the Aussie dollar up, and the Kiwi would follow, because it always does. So there are the things that, over coming months, I think it's more about interest rate changes, more so than, say, your geopolitical events. Can't predict those. You got to determine exchange rate direction, and particularly the Aussie dollar. It's been very weak for 2 years now. A few times it's tried to break higher and it's sort of failed and comes back down again. But its interest rates are more than 1% below the US. Now, when that changes and the US interest rates are cut and potentially the Aussie interest rates increased, that whole dynamic changes, and you'll see a lot of unwinding of short-sold Aussie positions, which could propel the Aussie dollar to a much higher level. So those are the things I see coming up in coming months to keep a lookout for. And, the balance of risk probability is, weaker US and stronger Kiwi and Aussie.
All right. That's something to put on the calendar. But So if people want to follow you, Roger, like I know that I follow a lot of your stuff on LinkedIn. Is that the best place for people to connect with you is on LinkedIn?
Yeah, man, I write a commentary every week, every Sunday. That's published on LinkedIn. That's also on interest.co.nz. They put it up there. It's just my view, my opinion of the forces that are, and it's mainly about the Kiwi dollar and the Aussie dollar and the US dollar. And that obviously goes to our clients as well, but that's just our view on how we're reading the events. And I've been traveling overseas for the last 2 months, just got home, but I still write the column. So there we are. I'm absolutely addicted.
Yeah, that's right. Well, there's what you do, and then there's who you are, but this is clearly who you are. So yeah, keep up the good work.